Dollar's buying power drops sharply over 10 years. Now think about that same dollar 10 years from now. It won't buy what it does today because of inflation. On average, the US inflation rate has been around 3% per year over the long term. This means that if prices increase by 3% annually, your dollar will lose about 1/3 of its purchasing power every decade. Inflation gradually makes goods and services more expensive while reducing the real value of your savings. Inflation is not some distant threat. It's a very real cost you pay every day, and the longer you ignore it, the harder it impacts your pocketbook. But here's an often overlooked aspect. The impact of inflation on your personal finances isn't just about rising prices, it also affects how much purchasing power you lose if you don't keep up with its effects. Let's start with a concrete example. Imagine you put $10,000 into a savings account that earns nothing, but sits there for 10 years. Now imagine instead you had invested the same amount in an index fund that averages 7% per year before considering inflation. Let's see how those numbers stack up against the cost of living over time. Over 10 years, if prices rise at a steady 3% annually due to inflation, $10,000 will lose significant purchasing power even though it remains unchanged in nominal terms. Specifically, its real value would drop to approximately $7,441, illustrating the eroding effect of inflation on money left idle. Meanwhile, an index fund, assuming an average annual return of around 7%, could grow significantly more than you might think possible, potentially increasing your initial investment substantially over time due to the power of compounding returns and market growth. Here's how the math works. At a steady 3% inflation rate over 10 years, your $10,000 will only be worth about $7,441 in terms of what it can buy today. That means if prices rise by just 3% each year, that same amount of money buys you less and less each year. Now let's look at the index fund growing at an average of 7% per year before accounting for inflation. After 10 years, your initial $10,000 investment would be worth around $19,672 in nominal terms if there was no inflation. But here's where things get tricky. You need to factor in the impact of inflation on that growth. If we assume an average annual inflation rate of 2%, after 10 years your initial $10,000 would only be worth approximately $13,617 in real terms due to inflation reducing purchasing power. When we adjust for an inflation rate of 3%, the real value of an investment earning 7% annually after 10 years is actually closer to $14,869, calculated as $20,000/1.344 equals $14,869, where 1.344 is 1 plus 003, 10. That's still a significant improvement over simply leaving your money idle in cash with zero return. The boring option quietly beat the exciting one every single time when adjusted for inflation. So here's the first key takeaway. If you don't actively work against inflation by growing your investments at least as fast as prices rise, you're slowly losing ground in real terms. This isn't about gambling or high-risk strategies. It's simply putting your money to work so it can keep pace with rising costs. Now let's dive into the mechanics of how this happens. The key is understanding compound interest and its opposite, compound cost erosion from inflation. Imagine starting with $1,000 in an account that grows at 7% annually before accounting for inflation. After 1 year, you have $1,070. But if prices rise by 3%, your purchasing power drops to about $1,039, since the original $1,000 can now only buy what $970 bought last year due to a 3% increase in costs. The next year, the process repeats. Your $1,070 grows to roughly $1,145, but then loses value as inflation reduces it back to around $1,112 in real terms. Over time, this compounding effect means that even small differences between growth rates and inflation can lead to significant gaps between what you end up with versus what your money could buy. Now let's talk about why people often fail to beat inflation over the long term. It's not just about choosing investments poorly, it's also due to psychological biases such as risk aversion. People tend to avoid investing in stocks or bonds, thinking that keeping cash is safer than other investment options. But in reality, holding onto cash without earning any interest leaves you more vulnerable to inflation, which erodes the purchasing power of your money over time. Another big mistake is focusing too much on short-term gains. Day trading and chasing hot stocks might seem exciting, but research shows that the vast majority of day traders lose money over time, especially when factoring in transaction costs and fees. These activities can distract from the real goal, long-term growth that keeps up with rising prices through consistent investing strategies. So what's the best way to fight inflation? The boring option is actually your friend here. Index funds offer a straightforward solution because they track broad market performance, reducing risk while still growing at rates that historically outpace inflation over the long term. They also tend to have lower fees than actively managed funds, which compounds over time and helps you keep more of your gains. Another key strategy is diversification. Spreading your money across different types of investments like stocks, bonds, real estate, and even commodities can help protect against the unpredictable effects of inflation. By not relying too heavily on any single type of asset, you give yourself a better chance to maintain the purchasing power of your wealth over time. It's also crucial to keep an eye on fees. Even seemingly small annual management fees can eat away at your returns over decades. For example, a 1% fee might seem negligible, but it costs you $10 for every $1,000 invested each year. Over 30 years, assuming an average annual return of 7%, that same fee would reduce your growth potential by approximately 1/3 on a modest investment. It's like having a leech attached to your wallet. Inflation isn't just an abstract concept. It affects everything from groceries to housing to healthcare costs. Ignoring inflation makes it harder to maintain the same standard of living over time. You can't combat inflation by storing cash under your mattress or keeping too much in low-interest savings accounts, as these methods do not protect your purchasing power effectively. So here's what you need to do. Start small and build gradually. Open a retirement account like an IRA or 401k, even if it's just a few dollars at first. Every little bit counts, especially when compounded over time through the power of reinvesting earnings. Look into index funds and consider diversifying your investments to stay ahead of rising costs. Another essential step is budgeting for the future now. Set aside money regularly for emergencies and long-term goals. Starting early allows compounding interest to work in your favor, meaning every dollar saved or invested today can buy more tomorrow than it'll years from now due to the effects of inflation. And remember this, every single day that goes by without actively managing your finances against inflation is a day when the silent thief eats away at what could have been your future purchasing power. Inflation isn't something you can ignore. It's real and relentless, reducing your money's value bit by bit if you're not careful. Now here's the big reveal. The most effective way to fight inflation is often the least flashy option out there. You don't need exotic investments or risky bets to protect yourself financially over time. Simply putting your money into solid, low-cost index funds and keeping it invested for the long term can help you stay ahead of inflation more effectively than any get-rich-quick scheme. The boring truth that beats the exciting lie is this. A steady approach of disciplined investing, compounded growth, and consistent savings can secure your financial future more reliably than anything flashy or speculative. It's about understanding the math behind how inflation impacts purchasing power over time and making choices based on cold, hard numbers rather than fleeting trends or emotional whims. So here's the final reminder. Combating inflation isn't just about avoiding losses. It's also about actively growing your wealth to keep pace with rising costs over time. The key is taking consistent action now, rather than relying on hope for future miracles. This has been the Money Files. This channel is financial education, not financial advice. Do your own research and talk to a licensed professional for decisions about your money. Inflation can be like a silent thief, eating away at the purchasing power of your hard-earned dollars without you even noticing it. Let's dive into some real-world numbers. If inflation averages around 3% annually, an item that costs $100 today would cost approximately $200 in just 25 years due to the compounding effect of inflation over time. That's a significant hit to your wallet. Here's the math. Imagine you have $1,000 invested and it grows at an average rate of 7%. After 25 years with compound interest, that initial investment could be worth around $4,322. But if inflation is eating away at that growth by 3%, your real gains are actually closer to 4% annually, 7% nominal return minus 3% inflation. Over those same 25 years, the purchasing power of your money would grow more slowly, increasing from $1,000 to approximately $2,698 in terms of today's dollars. Key lesson here is that inflation isn't just a concern. It's a crucial factor in planning for your financial future. It's important to invest wisely and ensure your wealth grows at a rate faster than inflation shrinks it. Think about this. How many people do you know who save diligently but don't quite beat the rate of inflation over time? they end up with less buying power despite their efforts. That's why understanding the impact of compound interest and inflation is crucial. Every dollar you put away now has the potential to grow exponentially, but that growth needs to outpace rising prices if it's going to maintain or increase your purchasing power in the long run. Let's look at a practical example. Say you're 25 years old and decide to invest $100 monthly in an index fund with average historical returns of about 7% annually. By age 65, accounting for an inflation rate around 3%, your investment would grow to approximately $400,000 in today's dollars. However, if your investments only returned the inflation rate, meaning they just kept pace with rising prices, you'd end up with a much smaller purchasing power equivalent, potentially not enough to cover basic costs. The boring option quietly beats the exciting one every single time. Stick to a steady investment plan and avoid attempting to outsmart the market. Diversify your portfolio, keep fees low, and remain disciplined. These simple strategies often distinguish financial success from struggle. Investing wisely can help protect your wealth from inflation's erosion. Understand how inflation affects your purchasing power over time and take steps now to protect your future financial security. This is educational and historical, not financial advice.